Larry, let's go ahead and start off with having you do an intro on yourself, kind of how what you're doing, how you're doing it, and then Travis, I'll have you do an intro as well, and then I'll
Yep.
intro and we'll kick it off.
Perfect. Perfect. Absolutely appreciate the opportunity. So what role do I play in this whole thing? I'm the tax guy. And the reason we start there is because it doesn't matter what you do, all roads lead back to tax in some capacity. And so our firm, what we do is essentially work with business owners to help them craft tax strategies and tax plans that, quite frankly, help you hold on to more of your money and send less of it off to the government. Taxes tend to be your largest expense, and we just want to help you save more of it.
Well, Larry, I don't think anybody's going to be interested in that. We all like sending our money to the government.
Yeah. Well, when you say tax, people just like, whatever. But then you say, look, I'm going to show you how to save. We're all in.
Exactly. So, Trav, give us your background for those of most people are going to know who you are, but
Yeah, maybe, right? But I'm Travis Hasse, actually from Madison, Wisconsin, and currently I operate Amazon delivery service partner. So we kind of dub it. So when you hear us talk DSP, as a lot of people that we geared this actually towards were just for DSP owners. We deliver packages for Amazon. So we have all of our employees. It's a pretty good, I can't go into dead specifics on Amazon contracts just for proprietary information for that, just to be respectful to Amazon, who is our customer as always, but obviously we're delivering to Amazon customers. So basically, yeah, from that standpoint, Shannon and I know each other from a mastermind group that's called The Collective. A lot of us think the same. My mentor is a gentleman by the name of Kenny McElroy, who's pretty heavy into real estate. And the venture I went there is I'm always constantly on that hunt to find good people that are around me to educate myself, even though Kenny and I are in complete different types of businesses. But I currently am now obviously starting to, buy real estate to help offset our taxes from that's generated from our DSP. So seeing that, just kind of like what leads us to this is, I kind of want to go on an adventure to help educate fellow colleagues as DSPs, to look at how they can actually keep some of their money. And obviously Larry and I just met each other through Shannon, on here to help because you're a tax professional. That's what you do. It ins and outs, and Shannon's talked highly about it. So it's a pleasure to meet you, obviously, on this webinar. But basically, here it's just to have kind of an open concept to tell, kind of show DSPs that they can invest some of their money instead of giving it to the government, which obviously isn't a bad thing. You're making money, you're paying taxes, but I'd rather partner with the government, learn the good tax strategies, and invest into myself and to obviously other people in our community. So, but yeah, kind of a good rundown.
yeah, that's great. And Travis, you say that you're not in the same business as Kenny. Kenny's got about a $2.5 billion real estate portfolio, but at the rate you're going, it won't take long for you to get there.
Right.
So my name is Shannon Robnett. I am a second generation builder developer, fourth generation realtor, and I've been in real estate my whole life. And so for me, if you guys haven't read the book Rich Dad Poor Dad by Robert Kiyosaki, it's kind of like the first step in getting to understand how money is made. And I always saw that growing up. I saw that with my parents buying and selling stuff all the time. And what I've learned is over the last 27 years of doing this in business is that there's absolutely no reason to pay taxes. Larry and I met about 2 years ago through a couple of different avenues. But what I've found is that in that time period, Larry's information is incredibly solid. As you guys will hear him today, he'll quote tax code. He'll get all accounting on us. But Larry's not here to replace your accountant. He's here to provide tax strategy advice. I use him exclusively on all our stuff. We vet all of our deals through him, just so that we make sure that the tax code as it reads is the way that we implement that. And We've currently done about $350 million worth of real estate development. I've been the buyer and seller or seller on about $250 million worth of real estate. We built everything from police stations, fire stations, city halls, um, schools, athletic facilities, you name it, we've done it. And over the last couple of years, I've transitioned into a place where we no longer are a merchant builder for others. We strictly work on our personal portfolio. And we have done that in a way that we partner with others through syndication, and we help others find that tax savings. And one of the best ways to do that is to educate people and to get people to understand what their abilities are, and then create a plan so that, like Travis said, you're partnering with the government. The government cannot build housing, but they can incentivize people to build and own housing and create rental properties. And so all of that is what we're going to get discussing today. One of the things that I've really been impressed with Travis about is he's a student. He really digs in. He really digs deep to figure out what he can do. And then he has assembled, like me, a cadre of professionals that help him implement this. And the more we talked, the more we realized this was information that needed to get out to people that are in similar positions. So Travis, if we can, we'll just start off with going, let's talk about what's not great about your business, in the sense that we understand who your customer is, but you have employees. You don't really own anything. You lease all your vehicles. You don't really have a location. You work out of Amazon's designated spot there. But tell us a little bit about what you were facing when you started with, the things you could not write off, the things that were not able for you to be able to be tax efficient with.
Yeah, correct. Yeah, good question. Basically it's a good cash flow business, right? And that's what a lot of people really look for in a business. Obviously, you can take great advantage of it. You have a great customer that's going to pay their bills on time, right? Knock on wood. Like when we submit, we've got an integrated invoicing system, and everything works great from there. The things that we don't have is we don't, like Shannon said, we don't own our own vans that we're out delivering in. They're either rented or they're leased through a nice program that we have set up through Amazon. Good thing is you don't have the capital outflow, right? It's very not capital intensive to get into the program. Bad thing is you don't have a lot of things to depreciate. So a lot of us go off as DSP owners because we own our own separate businesses. We have our own separate employees, and just kind of like the size of my company, we have about 135 to 140 full-time employees, and we've got a fleet of 84 branded Amazon vans. I do run two separate stations. One's a ZL, which is delivering envelopes and packages up to 50 pounds. And then I run an XL station, which is packages 70 and above. And luckily, those two different stations, which are owned by Amazon, are at least through Amazon, but we go there and we pick up packages. We go out and deliver, and then we come back to that same place, and check in once our routes are done. The vans are parked at an Amazon parking lot, which is great because they have security and people that are around there. We have maintenance opportunities there, or we can go off and use our own maintenance people. So basically our expenses are our employees, insurance, workers' comp insurance, normal, obviously general liability and cargo insurance. We have dispatchers, and, basically we have revenue that comes in, but we don't have a lot to depreciate. So the model that I looked at is, how can I take some of this cash flow that I'm getting, and what can I do to go out on a venture to find out how to invest into myself versus paying less tax, right? Prior to this, I was lucky enough where I exited a company in late 2018, 2019, right before COVID hit, which was great. I used to own a spirits company. If you can Google me, you can find some things, that are out there, good and bad, right? But I had such, I thought I had at that time good team members around me, and I paid millions in lawyer fees and accounting fees over the time that I owned this spirits company. And then when I sold it, I just looked at the tax money that I wrote from the sale of a capital gain, and it was life-changing money. So I was always like, how do people talk about how they can invest and do all this stuff to obviously minimize their tax? And that's when I went on my adventure that I said, hey, I just got to find better professionals that are around me. Along this journey, obviously the DSP program came along, and I'm like, hey, this is great cash flow opportunity. You know, now I have income coming in, a good solid business. We're a little over 3 years into business. So now I got borrowing power with the bank because I'm showing consistent, you know, profitability within our company, a history, constant cash flow. So that takes care of the check mark to buy, you know, to be able to get loans. And then I figured out a way to look at structuring my business, you know, in my standpoint as an S corp, right? But then I was able to get a right team around me, acquire some properties, and then push myself into a real estate professional category. And then I was able to set my DSP up to where I have the right management staff. I can do the right minutes. I can do all the right documentation of how I actually run that. So then I can turn that S corp into passive income, buy properties, do a cost segregation, and draw down my tax. So basically that money that I'm going to spend on taxes, I'm putting as down payments in the properties. And now I'm able to catch up, and I can keep rolling year after year. And, you know, I carry over losses and I don't pay any tax, and I'm investing into myself.
Okay, so Larry, he used a lot of terms: cost segregation
Yeah.
study, depreciation, you know. So tell us, Larry, go through a little bit what Travis doesn't have in his business that, say, like a construction company like mine would have, as far as, you know, tax write-offs. And everybody hears about the write-offs. You know, what can you do to write things off? What can you do to depreciate things? How does that happen? And then let's talk a little bit more about some of the terminology that Travis was using with everything that he was talking about.
Yeah, well, first, let me say we could wrap it up and go home. I think Travis just kind of laid the foundation pretty solid on
Yeah.
strategy and plan there. So here's the big deal. When you think about depreciation, or just when you think about tax planning in general, the idea here, especially when you look at other companies like yours that are in the construction space, you're purchasing heavy equipment. You're purchasing a lot of things that, quite frankly, cost a lot of money. But the cool thing is, it's not a huge cash outlay. A lot of times we're financing those, or we're getting some pretty reasonable terms. But the key there is that the business now owns that thing, whatever it is. They own it as an asset. And these assets fall into a particular, what the IRS calls a useful life. And if it falls into a particular category, whether or not you financed it or paid all cash for it, you can take a depreciation deduction for that asset up to the tune of 80% this year. In prior years, it was 100%, but you can depreciate up to 80% of that purchase price in year one. So when you think about it, if let's say Travis's example was a little different and they are actually buying their fleet and not leasing it, if they go out and purchase, you know, these delivery vehicles that are, I don't call it $200,000, $300,000, or whatever that number is, now, even though they're not paying $300,000 in actual cash to purchase them, they're going to finance them on terms. The business is out of what, 30 or 40K, but they can take a $300,000 tax deduction simply because they own the asset and it falls into a particular class. So that's really the value here. And then that translates over to the real estate side as well.
You know, and that's as you guys can imagine, this is why I have Larry on here, because he is the one that kind of makes sure that what Travis and I are talking about gets broken down the way that it does. So, you know, one of the things that I look at when I look at a deal is just like Travis does. I look at, how do you get around paying the taxes? Larry and I, this last year, I have a business that I started. I'm a pilot. I love flying. But Larry and I were able to depreciate a complete airplane in 1 year. And the math on that shows that we were able to, instead of, like Travis said, give the government $100,000 in taxes, I was able to put $80,000 down on an airplane, put it into service, make it a cash flowing asset, And instead of putting that money, sending that to the government and then going and putting a down payment on an airplane, was able to do that in a way that now I actually received a tax benefit that was greater than my deposit or my down payment on the aircraft. So with that, let's kind of jump in, Travis. So some of the things that you've done is by setting yourself up as a designated real estate investor or designated real estate professional, you've taken yourself and put yourself in a special category. But before we get there, Larry, what can the average person look at if they're looking at how to convert cash flow, where you've got limited deductions like these DSPs would have, and other people that are in very low hard asset environments, what would they be able to typically depreciate? What would they be able to typically write off in their portfolio that would allow them to minimize their taxes?
Yeah, that's a great question. So I'll start with write-offs and then I'll jump to depreciation. The first place that we always suggest that people look is one, cash flow is king and queen of the business, right? And so when you're looking at tax deductions, you don't want to spend money just for the sake of spending money because it never comes back to you dollar for dollar. So you want to look strategically at where am I already spending money that has a business purpose, right? There are 5 things that need to happen when you take a deduction. It has to have a business purpose. It has to be what they call ordinary in your line of business. When we look at other businesses, do they do the same thing? It has to be necessary for you to take this expense to turn a profit. And then it has to be documented. Last is it has to be reasonable. As long as we hit those 5 things, then we're kind of in the space of appropriate tax deductions. So if you don't have a designated office space, you're already working out of your home, which work from home culture is taking over now, we can look at that as a potential tax deduction, writing off a portion of your main home. And when you do that, you have a vehicle, we could look at the mileage deduction. We're looking at 66 cents per mile this year. And then it all just starts to add on, even things as simple as hiring your family that if you have a reasonable basis for making them an employee of your company and you're already supporting them financially, it could make sense to hire them into the business, have them perform services for the business. Now you get a tax deduction for paying them. But the point here is the first place to look is, where am I already spending money that I can repurpose that money to have an appropriate business expense associated and related to it. From there, we then start to look at the assets. Does it make sense to purchase a vehicle, a heavy vehicle specifically, where you can get the accelerated depreciation? As Travis mentioned, does it then make sense to jump into the real estate space and start to look at some other assets? You take the cash flow that you're getting in a tax efficient way and you go buy income producing assets. That's where you really start to make your money work for you.
You know, Larry, you hit the nail on the head. I hate paying for anything. So if there's any way I could get somebody else to pay for it, like rental property or things like that, that's definitely top on my list. But, you know, Travis, when you started to look at this, you realized that the structure that you had with just a straight Amazon DSP, straight cash to you, wasn't really going to work very well because it didn't allow you the opportunity to move things around or to be tax efficient. Tell me a little bit more about what you started to structure initially and where you wound up going on that whole thing.
Yeah, good question. You know, I think that, you know, even getting into this program and then, you know, you'll hear like if people, a lot of people that are out there, if they, you know, the best thing that I always say is to start with the Rich Dad Poor Dad book, because everybody that I know, I kind of went to this venture, all came across that book with Robert Kiyosaki at some time. I would bet 75, and Larry, this, like I said, the first time I met you, I know when you picked up that book, you were probably like, wow, he just looks at the world in a different way from how we were taught in school, right? And I would say that the same mindset is I think a lot of people come in, maybe have more of an employee mindset versus an entrepreneur mindset. And my point, how I'll unwrap that a little bit, is people will go right to a P&L and see how much money they made, right? Versus looking at cash flow, balance sheet, profit and loss, and seeing that, because you want to have that positive cash flow to generate in the P&L, right? Looking at your income. and then what you can do with that. So I think the first thing was for me was to shift that mindset from thinking like an employee where I look at my check and I see what's left over, to looking at, okay, I'm making income. Now I can have expenses, right? So if I have money coming in and then I have expenses that I have first, and then I have money left over, versus in an employee standpoint, you're making money, you're paying taxes, right out of your check, and then you have your expenses, and now I got money left over. So I'd rather be in control of those expenses and where I'm going to invest. So that was just kind of like that main mindset that I shifted on. And then, doing a lot of research and finding good people around me. And then that's when I took that step into taking the rest of that money and that good cash flow. And then I just found the best opportunity for myself was into real estate. But I had to dial in with good people around me. What is the best way to plan? It doesn't happen overnight. What is the best way that I could plan to go out? And I wrote out my goals by XYZ year. I don't want to pay any tax, but then I want to get enough property that I can suffice a tax code, which I'll ask Larry to define this, where I can actually call myself a real estate professional or a real estate investor. Which that is something I'll let Larry define, just because he's going to know that in and out of how I can turn my company into passive income the way that I have it structured, and obviously take my income now from my DSP, which allows me to depreciate that income from that DSP off of my real estate through cost segregation depreciation.
So real quick, Travis, I'm going to put you on the spot.
Yeah.
Have you filed your 22 taxes?
Yes.
How much did you pay in taxes this year?
0.
There you go.
I actually carried over multiple 6 figures in losses.
There you go. So it's not rocket science. It's just it's a process. It's a plan. So Larry, let's talk about that structure a little bit. You've got your DSP, you've got your LLC, you've got that set up. You're ready to go. What are some of the things that you need to look at that you can start with how to structure that?
Yeah, the first place to start is really understanding the entity structure itself. So like you mentioned initially, most of us are going to start with an LLC of some sort. And then Travis made a comment earlier that typically as the business starts to get more profitable, then when you sit down and talk to your accountant, there's a good chance that they'll suggest that your LLC then make an election to be taxed as an S corporation. The value that you get there is now you get to save a little bit on employment tax, Social Security and Medicare tax, basically. So you elect to be taxed as an S corporation. Part of your earnings are going to be a salary. Part of your earnings are going to be a distribution, but you start to achieve a little bit of savings. Where it really starts to happen, and this is more a business process and growth and scaling, is when you can remove yourself from the hands-on day-to-day activity and management. You start to follow Kiyosaki's cash flow quadrant, and you move from business owner to investor. So you're no longer in on the day-to-day operations, having to touch things, having to coordinate, having to manage people. You've got folks in the business that do that, or you have another partner that does that. When you can achieve that, then you start to become passive in your own business, which is a good thing. Again, if you're following Robert's cash flow quadrant, this is when you make it to the road of being an investor. Well, when that happens, the income that flows from that business is treated as passive income, similar to how real estate income is treated. It's not subject to employment tax or anything like that. But the key here is it's passive activity. So when you have losses, which we'll talk about how to generate these losses, but when you have losses from real estate, which is a passive activity, and you have income from a business that's a passive activity, those two things come together. Passive losses offset your passive income. And you get into a situation where all of a sudden you find yourself making more money, but not necessarily paying more tax.
And that's the goal, right? So let's talk about this, Travis. So you started you got your basic stuff set up. You started seeing how you could become a real estate professional. I'm going to put up a chart here that you put together for us. that shows how your companies are structured. I want you to kind of explain that to me.
Yep. And this is just a small basic. It's not my actual, right? You know what I
Yeah.
mean? But it gets the gist down. And
Right.
Larry can even critique it, right?
Yeah. Yeah.
So-
Larry, this is the first time you've seen it. So
Yeah, this is Laz's first time that I've
And
seen it.
and I got to tell you, part of the reason I didn't want to preface a lot of this is because I didn't want this. I want it to be real live and get opinions that are on it.
Yeah.
So basically how I'm set up. So this is a little bit, so I have a bridge trust, Larry, and the reason why is because I have 84 vans that are on the road, right? And we have a lot of liability, and our biggest exposures that are going to be out there are going to be accidents, right? So I actually have a bridge trust, right, that is actually set up. And so I did a lot of research on trying to buy multiple millions of umbrella insurance that would go over top of these vehicles. And it was very expensive. Each layer was, tens of thousands for each layers of millions that you put over top of it. Because currently right now, most of our policies that we have to have with Amazon have a $1 million, obviously, limit per incident, right? But then again, too, it's like, what happens if that goes over? So when you see my name at the top, and this is kind of where we get into, what are the things that you own and what are the things that you can control, right, through other entities. I have a revocable living trust, so there's some different things that lay out to that. But the basic core of what I have is I have an Arizona limited partnership. And you'll hear some lawyers or some asset protection attorneys talk about Wyoming, Delaware, and even Arizona just have good laws for piercing a corporate veil. Okay. From that standpoint, right? So I have my setup as like my real estate. Okay. I have an Arizona limited partnership, and then every single property, this isn't the actual count, but every single property multiple that I have, each property is in a separate LLC. Okay. But those are owned by the Arizona limited partnership. And one of the reasons I set that up that way is so I own multiple properties in separate different states. So each LLC is domicile where that asset is located. And then that's all owned by my general partnership, okay, which is owned 98% from my bridge trust. And then I own 1% as the general partner. And then I have one other person that owns 1%. And the reason I do that is because, in an audit or et cetera, they, do XYZ LLC real estate, that it flows through the partnership. So they would actually have to open up an audit on every single separate entity instead of owning. If I was a sole member LLC and it flowed up to me, that gets a little bit tricky, but that's the reason why I have it set up this way. But then I have my entity over to the side where it's the DSP operation entity as an LLC. And that's the one that's taxed as an S corp. So through my trust and stuff, I actually have that is owned separately, because you may be able to answer this question. From what I know is that a partnership can't own an LLC that's taxed as an S corp. And you may be able to correct me on that. And that's the reason I have it split off to the side, because that's a major generating income. And that is actually, I've turned that entity through my minutes of my corporate structure, where I actually hired one more employee that gets me out of that. So I have a general manager, an HR manager, and a safety and quality manager that goes over fleet and our safety, et cetera. So then once a week, I meet with them. And then every year I log my minutes of who's my GM, who's my HR, so I can, keep track of my corporate minutes, who everybody is. And then that's, basically by just a nutshell, by looking at it, kind of how I have my structure set up for asset protection and tax advantages and investing.
So the reality is, the goal here is to reduce your tax bills. The goal is to get to a place where you've created enough offset that you're not having to fork over money to the IRS. But Travis, you've taken that one step further. You've involved asset protection as well, because you desperately need that, as all of you guys know on this call, that if you've got 135 people out there wielding 8,000-pound vehicles down the road, you're going to have some opportunity to be exposed to liability. But the real thing that we look at, and the thing that we do very well, is we look at how to get those to convert your cash flow today into passive income that continues to pay you forever, right? And that's one of the best things about real estate, is because you're able to take the money that you're making today, you're able to put that as a down payment, you're able to put that into real estate, you're able to get the things involved and the things moving forward that you're wanting, so that whether or not you're a DSP in 2 years or 5 years, you still have an income coming in from the assets you were able to buy. Now, Larry, when you're looking at this chart, you're seeing what's going on and you're seeing how he's put this together. Let's talk about why the IRS wants you to have different entities, or the preferential treatment is there for you to have different entities that allow you to have the layers, and why certain entities need to be receiving certain income and certain entities maybe need to be receiving other income or different income.
Yeah, absolutely. This is really good. So to answer that question, essentially, what you don't want to do, and what this structure allows you to avoid, is commingle funds. And that's basically mixing your business and personal, or mixing the funds between different businesses. So seeing right here that Travis has separate LLCs for each of the real estate entities, that's basically so that property A doesn't collect rent from that was actually supposed to go to property B and then pay for property C's repair and maintenance, right? Because then you're just commingling things. In the event that some type of judgment or liability happens, a savvy attorney is going to say, look, this thing is so crisscrossed that we don't know what's what. We want to have access to all of it. So this allows you to keep it in silos and keep it in buckets and further expand your asset protection. It also makes it very easy from an audit perspective to follow the trail. As long as everything moves accordingly, it makes it easier to follow the trail and proof out any of the things you need to proof out with respect to an audit. So we certainly like it for those reasons. The second thing is the type of income is separated here. You've got your passive income flowing into a bucket. You've got your active income flowing into another bucket. Now, Travis has done some other things to make the transition to make both of those things passive. But if you look back at the initial start, the Amazon DSP side, when you're hands-on in managing that business, or any business for that matter, that's considered active income. It's subject to employment tax, which is Social Security and Medicare tax, like we talked about. That's separate from the passive income, like real estate, which is only subject to ordinary tax. So you get to keep the type of money that you're earning separate, and then you also get to have separate lines in terms of the flow of funds, so that you can avoid any issues with an audit or any liability. But then you can also see these are all pass-through entities to an extent, and so they essentially all flow up to one place. So good. I mean, I like what I'm seeing so far. And obviously for most folks out there, a lot of this is it depends, right? This is a perfect structure for how Travis has done things. Your situation may be slightly different, but I think it gives a great guiding light to what most folks are after: tax protection and asset protection.
So before you guys get all wrapped around the axle on this and go, wow, how do I even go about creating that? That's really kind of the purpose for this call. Travis, you did some deep diving on your own. I know you read a lot, you listen to a lot of podcasts, you study a lot, but what was the catalyst there? You read Kiyosaki's book, you understood that. What was really the catalyst for you tracking down the right people to get this structure set up? And how did you go through that process?
You know what? Actually through, just like you said, just talking to people and meeting people. I met a good friend, Winston, who's, he's down in Nashville, has a lot of property, and he helped me set me up, him and his wife, with the bookkeeping, just like how Larry said, don't commingle your funds. So every single property has its own separate checking account. Every single property is completely separated. So to keep good bookkeeping, right, I just set that up and went to the right sources. And one of it was how I got to this level in the beginning was I met another gentleman at a macroeconomics event, a friend Damien of mine, and he and I were just talking tax strategies, and he kind of wrote it out on a napkin and said, here's an idea, go find some professionals that are around you to help you structure this. And I think that's one of the things too, what I was scared about was, I always had the local accountant, I always had the local bookkeeper, which it's not bad. But I just, during what I had learned too, is I kind of felt that I could just find maybe that next level person that actually can look at things just a little bit differently. And that journey actually took me to finding a CPA and CPA out of Jacksonville, Florida, and tax strategist. And I found an asset protection attorney in Arizona. And just asking those questions and finding that path. And that's how I ended up where I am today. And I think the biggest part is I think a lot of people are scared to get rid of that local person that they know in their neighborhood. But in all reality, it's like that you sometimes you end up outgrowing those bookkeepers and you outgrowing those tax strategists, because they may be great at processing taxes, right, as an accountant, just taking the information you're giving them and processing it, versus meeting up with somebody like Larry and doing a tax strategy, looking at how can we actually plan for the future and structure this differently. And then you turn around and you have an accountant file your taxes for you as you work out your plan. If that's
and Larry, you and I have spent a lot of time doing this kind of thing, and you're not my accountant. You're an asset that we use that really kind of just focuses on the tax strategy. And as Travis has found and pointed out, it's very difficult to find an accountant that does all in one. And I think one of the things that I hear the most often from people is, why did my accountant tell me this, right? Which is really kind of the premise on which you founded your business, and the focus of your business is not to be everybody's accountant, because that in and of itself can get overwhelming, keeping everything straight and all the boxes. But, most people, they go into the end of the year, they celebrate Christmas, they go to New Year's, and then they go see their accountant in February when the cake's already baked. There's nothing you can do about it. And that's really where you and I have collaborated a lot, is to create these strategies based on the end goal being a zero tax, and to really build that backwards and go, okay, this is what we do. This is how we do it. Yes, this is what the tax code allows. Do it this way, not this way. And that's really been the premise on which you have worked and we have worked together. In doing that and in setting that up, what are some of the things that you're also seeing other people look at that, or as a former accountant, as a recovering accountant, what are some of the things that you see that people expect their accountants to do that they don't, and why is that so much of your business focus, and how do you help people get through the menagerie that Travis has navigated by himself just through persistence?
Yeah, absolutely. And it's exactly what you mentioned. Quite often, the expectation, especially as you're growing the business, is you got one CPA. Sometimes we want that CPA to do our bookkeeping. We want them to do our tax return. We want them to be available for questions. We want them to do strategy and planning and all this extra stuff. And it's really hard from a capacity perspective to be great at both. The talent and skill that it takes to accurately prepare a tax return, that meticulous level of detail and data, is a little different from the talent and skill it takes to do strategy and planning and understanding all the nuances that feed into it and lay out the full plan. In fact, for a lot of us, especially for growing businesses, I kind of liken it to the visionary and the integrator, right? You have the visionary who's almost like the strategist who has the grand idea, who structures and puts it together. Then you have the integrator, the preparer, who actually brings it to life and memorializes it on the compliance side. Very, very rare will those two people ever be the same. And so, as Travis indicated, at some point you kind of outgrow that profession and you start to look for other professionals who could help you get to that next level. And so the focus really, and this is where we've kind of shined a bright light, is how do we do the strategy and planning now? Because when you look at preparation, it's really memorializing accurately, of course, but memorializing all the stuff that already happened. You mentioned it, Shannon, the cake has already been baked. Now it's time to cut that bad boy open. For us, it's more about let's get in the kitchen and figure out the right ingredients to put into the cake to make sure we've got this whole thing set appropriately so that we know what the end goal is going to be when we get to the end. So our thing is you shouldn't leave the year with any surprises.
Right. And, we get together usually about March or April, see how the year's shaping up. We get together again about Thanksgiving time or October, kind of make sure that we're still on track. We go through each deal. But, the reality is what we've been talking about is not hard. All of you guys are running DSPs. And when Travis talks about 135 employees, I just want to lose my mind because I wouldn't know how to run 135 employees on a consistent basis. And that's part of what Amazon put together for you guys was that structure that allows you guys just to really plug and play. And that's why Travis and I got together. We thought this would be a great opportunity to talk with you guys about a structure that we put together that allows you guys to plug and play and understand that all the strategies and all the things that we're setting up are very easy to do when you're using the right people to do them with. If I were to think about shipping something across the country, it becomes a total pain for me. Amazon's got it down to a science. And so when you guys are hearing this, don't get overwhelmed by all of the stuff. We want you guys to look at what the overall is and grasp the concept of the fact that you no longer have to pay taxes if you're willing to put in a little bit of effort and some time to get things set up properly and then account for that time through the methods that are necessary to keep the IRS off your tax return and keep them out of your business and out of your funds. And one of the things that we have looked at doing is we do a lot of large scale multifamily and industrial stuff that allows people to participate on a grand level without having to try and do all the things that are involved with property ownership. You're not having to deal with the toilets, tenants, and trash. You're not having to deal with those kinds of things. And again, we're just one more professional that you can put into your repertoire that allows you not to have to do all of this yourself. So when you guys are thinking about this, don't melt down. It's actually very easy, and we're going to provide some information so that everybody can get a hold of the right people to get started to get this going. And so as we kind of come to the tail end of this, and we want to appreciate your guys' time and the time that you've jumped on, Travis, on this journey, how much of this was as hard as you thought it was?
It wasn't at all. And that's the building of the team aspect, right? And but it's the same thing. Like I always say, like with our company, it's not a science. It's called perfect puzzle, right? And it's actually taking people from all walks of life, from all around the world, and we bring them together. And packages just happens to be the common thing that we do. And it's actually just putting together that system and putting together the right people and finding them around you. But, as another thing, though, it's actually just taking that first step too, right? And that's everything that we do. It's, we all sent out the application. We're all entrepreneurs that started in the first place. So it's a little bit easier for us. That's the nice thing is that, there's a little bit of vision that people can see through it. And Larry may know this too. There's a lot of people that'll have separate accounts. They'll have their accounts going in for just taxes, right? That they're pulling back a third of their money or whatever it is of everything. And it's just going into one account for budgeting. But the thing that I like to say that you can actually take that money that you're going to use to save for tax, eventually you can keep up with it, that you can use that money you're saving for tax, use it as an investment tool, because you're using the same amount of money. Either going to write that money at the end of the year and it's going to say, U.S. Treasury on it or state of Wisconsin at the end of the day, or I can write that check as a down payment into a property or invest into a syndicated real estate deal in the right way. You got to make sure there's a lot that goes into that with accredited investors. And, you want to make sure that you're dialed up in there though. But that was the first step. And one of one of the questions everybody always has, and this could be even better, but Larry's question is, how do you start if you don't own any real estate to start getting yourself into the right path? And how do get yourself set up in the right tax strategy, I'll call it, to start. Because just overnight, you just can't pay no tax. You got to get that plan in place.
Well, the other thing too, Travis, before I turn it over to Larry, I want to ask you another question.
Yeah.
This piece of paper, and I'll put it up again.
Yeah.
What you've lined out here is, it looks pretty complicated, and usually in any business, if it's complicated, it's expensive.
Yeah.
What do you estimate you've got into setting all of this structure up and getting it running, not including your personal education or anything like that? What do you think this setup is cost you?
That all of it all in was about 25,000.
Okay, so you've
And
got
the most expensive part for me was my bridge trust. And, that's another topic that we can ask Larry on a different call, is that on the dirty dozen for the IRS list too. But the one thing that's nice is about a bridge trust is that it's not offshore accounts at this moment. I can actually move it to an offshore if there's a major lawsuit or liability, and it actually moves all those assets to Cook Island, which is north of New Zealand, but it's all US laws, right? So it just makes one more avenue for ambulance chasers, let's just call it, that they gotta move through different states and then go to another country to try to pull where the assets are owned. But I can always pull it back to the US. And then there's just, if I do accelerate it or do, push it forward, there's different tax forms that I have to file at that moment. But there's a little bit of maintenance fees of about $4,000 a year to keep that in line. But that asset protection attorney also files all my new LLCs, all the agent work that needs to be done for it. All my paperwork goes there. And then I sit down and make sure I got my minutes dialed in right for all my companies, just so I can be true to my operating agreements and everything else. And it's just like anything else, it's documentation. So, but all in all, I spent like 30,000 over the years to get that set up.
And before you guys start to panic about that number, Larry will tell you that is tax deductible. It is a business expense. But guys, before I'm going to let Larry close out with a couple of things, but I want to let you know to hit the Q&A, throw your questions in there. We got a little bit more time left. We'll answer some questions. But Larry, when you're looking at how people get to this place that Travis has gotten, that I've been for many years, where you're not paying a tax bill, what do you think the main reason that people don't do that is? And what do you think is the main block in front of them?
Yeah, I think the main reason is the number Travis threw out there, 25,000. They look at this as an expense and not necessarily as an investment. When you're doing strategy and planning, just think about it with your own business. You're doing strategy and planning so that you can increase revenue, increase profitability, hit KPIs. This is no different. You're doing strategy and planning. You're making strategic investments. Sometimes that's a professional fee that you have to pay, but you're getting a return on investment. And so if you're paying your strategist, I'm going to say $20,000, but they save you 60, that sounds like a win all day long. And not many people can step out of the, as Travis mentioned, employee mindset and look at it from a pure investment perspective. Just think about it, if that were an asset, I'm going to pay $20,000 in order to get a $60,000 property. Most people wouldn't blink twice at that. And it's the same when you're working with your professionals. And so you kind of elevate to a stage, quite frankly, where you have to pay to play. But the pay to play should come back to you as a return on your investment down the line. And once people get that, the floodgates open. Now it's like, hey, what other opportunities can I look at to really get an ROI? So it's really changing the mindset to be more of an investor and less of a business owner.
Yeah.
And that's
yep. Sorry, Shannon. And my mainstay is exactly like where you were going with it, Larry, is like, the Amazon thing is great, right? But as always, you always want to have a plan B and a plan C of everything you do, and different buckets of income, right? Especially that the way that today is going, where, things like a pandemic hit and certain things change and jobs change. And I also, own some other businesses, and another business that I own is a bar restaurant, right? That I've had for 20 years. So that's what I'm saying. My org chart is basic, but I've got some other ones that I just wanted to give it a good, simple one, cleaned up with not everything on it. So another DSP owner could just kind of get a good look at how I truly have the DSP operation set up as a real estate professional and meeting those requirements as material participation, 750 hours, and more than 50% of my time spent in real estate, right? Which isn't that hard to do, especially when you turn your DSP into a good team and you're passively involved, but you still are in operations, and Amazon knows in good faith you're still operating that company. But that, and having them different buckets for me was my main thing. It's kind of like, how did I do this? Yeah, to save tax, but I also want to have that plan B. And when people start seeing that real estate passive income that's coming in, as that starts compounding, right? And another thing that people miss is the phantom income that's on it. And when I say that, people are paying down your note. If you think about it like your house, every time you make a mortgage payment, you're actually in your amortization schedule, you're drawing down the debt. You hope you pick up inflation. We all talk about that, in the world. And your tenants obviously is serving that debt for you, and you're saving the tax money on it. So when you start looking at even all those angles of different buckets of income that you have, it's the true freedom comes is when you offset the income that you're making on your DSP, which a lot of people make great money. And then if that ever did go away someday, or if Amazon, God forbid, we don't have Sears and Roebuck anymore, and we don't have Kodak anymore. You know what I mean? You just don't know what's going to change years down in the future. And then you can set yourself up for a plan B with assets. And that's just basically the approach that I took with good people around me to execute that.
Yeah. So guys, we're gonna wrap this up. Let you guys. Christy's gonna throw a link in the chat. If you guys want to grab that, you can get more information on what you've seen here. Get connected with myself. Get connected with Larry. Ask more questions. But guys, we want to be respectful of your time. Thank you guys for showing up. And if you're interested in finding out more ways that you're able to convert your great jobs or your great businesses that you have with Amazon into financial freedom, reach out and connect with us at info@shannonrobnet.com. We will get you channeled in the right directions. We'll get you connected with Larry, and want to take the time to thank each and every one of you again for coming in. We're going to do some more of these. So we're going to do some deeper dives on some stuff. For those of you that have questions, go ahead and send those to info@shannonrobnet.com, and we'll get that circulated. But guys, this is the way that my life has functioned for a long time. This is the way that Travis lives his life. And this is the way that Larry does on a consistent basis to put people in a position where they are not paying taxes. They are, like Travis said, becoming investment partners with the IRS and allowing the IRS through their tax rules to allow them to create additional financial freedom. So I wanted to open it up for any questions. If you guys have questions, throw it in the chat or the Q&A, and we can answer those with our final 8 minutes. Other than that, guys, do you have anything else you want to add while we're waiting for questions?
No, nothing in particular from my side. Just one, this is an amazing conversation. I think it was really good because it puts into perspective the idea of, we talked about Robert's book, moving from the employee mindset all the way around that quadrant to the investor side. So that's where you get really tax efficient. That's also where you get quality of life back as well as you navigate around that whole quadrant.
Yeah. And actually, we've got a question here that is asking, am I able to continue to make active income while offsetting with my passive income? And how hard is that to keep separated? And I think the reality on that is just that if you're creating active income on one hand and passive income in the other, guys, the goal is to create enough passive losses that it offsets, obviously, your passive income, which is taxed at 20%, versus your active income that in a lot of cases, especially for those on the call, is reaching into the 30 and 37% bracket with just the federal government. So be able to create that. And when you purchase that asset, be able to draw down on that depreciation and offset that through the way that you've set up your companies to allow you to get to a zero tax bracket. And in doing that, be able to create the financial freedom, because now you're not putting 30%, 40% toward the clowns in Washington, you're able to put that back into your own business and continue to grow a portfolio that through appreciation will continue to provide a great passive income and a lifestyle you never thought possible. So with that, it doesn't appear that we have any questions. I want to thank you guys all again for coming. And again, info@shannonrobnet, and we'll connect you with everything you need to know, next steps, and how you can get involved with Larry, get some tax strategy, get your questions answered by Travis and Larry and I. And we'll let you guys know when we're getting ready to do this next webinar that'll dive a little bit deeper into that. So thanks everybody for coming today.